All right. Today is Wednesday, January 4th, and this is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. Now, let's start by this. Did the Grinch leave town finally? Did Santa make a late arrival? Perhaps. Or is it all gonna be one risk-on rally based on technicals and a beginning of the year optimism? And most importantly, can bad news be good news for the market right now? And this is what we're going to explore in tonight's program. And without further ado, here it is, in focus tonight. How about the McCarthy fiasco in the House? And then let's talk about the Fed minutes. And lastly, the mass layoffs in Salesforce. And we begin with a story from the Washington, D.C. brothel, and I'm putting it nicely. And a lot of you have been asking me today, what's up with this McCarthy deal? Is it going to impact the market one way or the other? I heard CNBC today talked about, oil prices are down because McCarthy did not get confirmed or whatever. And I'm like, what does that got to do with anything here? It has absolutely nothing to do with anything. Matter of fact, the Joe Biden administration and his policies are the best thing that ever happened to the oil industry and oil stocks. Because the hostility means lower supply, and that pushes oil prices higher. Matter of fact, if the Republicans take over the House, and technically they did, we're just waiting for a speaker, yet hypothetically speaking, if the Republicans took over the House and the Senate, oil prices would have crashed big time. And the reason is the Republicans will increase the production of oil in this country, meaning supply goes higher, prices go down. This is all ceremonial, of course. This loser, McCarthy, didn't get the votes once, twice, third time, fourth time. Matter of fact, last time I heard, sixth time was a failure too, and they had to adjourn. So now they have to find another nominee, and that's all. And at the end of the day, it doesn't matter. All of these politicians, Republicans, Democrats, are all snakes. McCarthy, McConnell, Nancy, them all. They don't work for you and me, they work for the deep state oligarchy. And that's it. And the sooner you realize that and you accept that, the easier your life is gonna be. Take, for example, this new budget that they just passed. What is it, $1.7 trillion? While we have inflation in this country, they're spending over $1 trillion. And the majority of this spending, of course, not to build hospitals or schools or make life better for the citizens of this country right here. The majority of this spending, of course, went to defense, quote-unquote, spending. In other words, money laundering. And if you dare speak against any of this, they're going to come back at you and say, what do you got against defense spending? What are you, Russian or something? You hate this country? We have to spend and build our military. Meanwhile, after spending trillions of dollars now, all of these generals or just salesmen for Lockheed and Northrop, they continue to bitch and moan about how depleted our military is. And if the spending really did go into military spending, how come we have all of these veterans homeless all over the place? We know the money's going for money laundering schemes. In addition, of course, to the Ukraine strip club that we continue to spend, making it rain, baby. Billions of dollars. And guess who approved all of this? For all of you who say, hey, Maverick, if you vote the other way, things gonna be better, yada, yada, yada. The U.S. House of Representatives backed legislation on Thursday paving the way for the defense budget to hit a record $858 billion next year. Listen to this, $45 billion more than proposed by President Joe Biden. In other words, the Republicans are just the same. Even worse, they want to spend more and more and more in money laundering. So what difference would it make if McCarthy becomes speaker or not? We're going to get robbed either way. And by the way, when I first came to this country, I went to watch a basketball game, and they asked all of us before the game started to stand up and salute our troops. And I'm like, what the hell is this? North Korea? I'm here to watch a ball game. And then they say, our troops in Kuwait are keeping us safe. And I'm like, wait a minute here. Last time I checked, Kuwait is not in America. So explain to me again how our troops are keeping us safe in Chicago by being in Kuwait and Korea. You gotta twist yourself in a pretzel to find an answer. But folks, at the end of the day, all what matters here is we'll deal with whatever legislations, whatever policies these corrupt snakes are gonna give us. Doesn't matter. We're going to deal with it all. For example, if you feel bad about being robbed in this defense, quote-unquote, spending, you can get your money back, at least some of it, some of your taxpayer money back, by investing in the same corruption, by buying shares in the defense contractors. Lockheed, Northrop. I've been holding Lockheed for over a year now. and it has been one of my best investments last year. So at least I'm getting some of my money back. Folks say, hey Maverick, why are you supporting Lockheed? I don't care about Lockheed. I'm just getting my money back, bitch. They stole it from me. So please don't be occupied about what happens in the House and all of this circus. It doesn't matter. At the end of the day, we'll deal with the policies. We will invest accordingly. And that's that. Now, the second story of the day comes from the Federal Reserve, another corrupt institution. And of course, we got the FOMC minutes, and the anticipation was that perhaps the Fed will outlay when they're going to cut rates. Well, guess what? The FOMC minutes came out solidifying that the Fed will back higher rates for longer. Higher for longer, which how I wish my days would be, but I gotta work. And of course, the market took a dump when we found out that no Fed official at all, none, expects interest rate cuts to be appropriate this year. Nobody. And even the most corrupt and most dovish Fed member, at least used to be, the demon from Minneapolis, Neil Kashkari. He says that inflation may have peaked, but he sees interest rates rising higher for the next few meetings. And listen to this. He sees the Fed raising rates by a full percentage point from the current rate of about 4.25% to 4.5%. That gets us to about 5.5%. And I say, Neil, forget about 1 percentage point. Of course, the news media, CNBC and the likes, they were saying, oh, look at Neil Kashkari, he's crazy. 5.5%, really? And I say, wait till you hear Bullard tomorrow, because the real rate has to go above 6%. This inflation fight is not over yet, and you will be surprised by how sticky inflation is despite all of the economic weakness we're seeing right now. Speaking of, remember last year when I said prepare for the tsunami of layoffs? And folks said, oh, Maverick, you're crazy. You're a perma bear. You're just being dramatic. Well, guess what we got today? Take a look.
6:16 breaking news into our newsroom this morning. San Francisco-based Salesforce will lay off about 10% of its employees. The company also says it will close some offices as part of its restructuring plan. It's still unclear if any of the Bay Area offices will be impacted. This is the latest company to undertake cost cuts in a challenging economy.
So Salesforce laying off 10% of the workforce, about 8,000 employees. That's on top of the thousands of employees laid off by Meta, Tesla, and soon enough Microsoft, Adobe, all of them. And of course, the most obvious fundamental reason for all of these layoffs is the fact that all of these companies responded to the bubble mania that was fueled by stimmies and trillions of dollars that the Fed stole from the next generation of this country to fluff up equities and real estate prices and increase demand in the economy artificially, creating inflation in the process, of course. And the consumer went bananas in 2020, 2021. Splurging, using the stimmies to buy cars, to buy goods, to buy services, to buy new homes, flipping Teslas, flipping homes, flipping pancakes, doesn't matter. And the companies assume that this is the new normal. The Fed is going to fluff up the economy with trillions and trillions of dollars, artificially stimulating the economy by fake demand. And this is the new normal. We're not going to have inflation. We never had inflation before, even though we've been having QE. Well, surprise, surprise, inflation popped out of nowhere, just like that herpes that you thought it was gone. Well, it's back now. And in response to this, the Fed is raising interest rates higher, tightening the monetary policy, and we see the equity valuation for all of these companies dropping like a rock. A crash here, a crash there, a crash all over the place. And all of a sudden, that demand is poof, gone. And these companies are left with these thousands of employees that they hired in response to fake demand. In other words, they overhired. And now that they're losing money and the equity valuation for the companies is going down, they have to improve the margins by laying off employees and reducing expenses since revenues are going down. But this is not going to be the only reason behind the tsunami of layoffs. There is another one. Perhaps a more important one, a more immediate one. Take a look.
I don't know where that transition came from, Joe, but we do have some breaking news this morning. Salesforce shares, they're actually moving higher after announcing job cuts as part of a broad restructuring with the goal of reducing operating costs, improving margins, and driving profitable growth. You see shares are up more than 2.5% right now.
So Salesforce admit that business is going down, demand is slowing, growth is slowing. All of this is bad news, yet the stock goes higher. Why? Because they're laying off employees, they're reducing their expenses, and therefore improving the margins as much as they can. And in response to that, the stock reacting positively. Now, I want you to do me a favor and think about what you think about.
Think about what you'd think about.
If you were the CEO of any other company, any of these tech companies, your stock is down from the top 40, 50, 60%. Business is slowing down. The shareholders are complaining. We're losing money here. The easiest way you can fluff up the stock higher and perhaps use the opportunity to dump and cash out is to announce mass layoffs. This is going to be contagious, folks, across the tech cohort, across retail, across travel companies soon. Mass layoffs are coming because number one, they overhired. Number two, they need to improve the margins. And number three, they need to fluff up the stock price higher so they can get out at a better price. Of course, the CEOs are not going to cut their pay. Of course, the CEOs are not going to cut expenses by reducing their packages. They're going to reduce expenses by getting rid of your ass. And therefore, I say, folks, if you've been hired in 2020, 2021 during the mania, and you have an insane salary, too good to be true, and your company is slowing down, the stock price is down, chances are you're going to lose your job soon. The problem is, I'm not saying you, I'm saying many Americans also assume that this is going to be the new normal. They're going to keep getting these inflated wages and they're going to keep their jobs. The jobs are in the bag. So they went on and splurged, buying homes they cannot really afford, taking rents they cannot really afford, taking mortgages they cannot really afford, taking auto loans they cannot really afford, etc., etc. What happens when they lose their jobs? They have to get rid of all of these positions because they can no longer afford them. And that's recessionary. And therefore I say, get rid of any obligations, any financial obligations you can no longer afford if you lose your job tomorrow. Pay your credit card down, look at your mortgage, look at your rent, look at your auto loan payment, and make a judgment here. If I lose my job tomorrow, do I have the cushion to continue to pay? And if not, I better have a plan right now. And while this is all sad and tragic, I don't know if you caught Jim Cramer today because he was gloating. He was having the time of his life over these mass layoffs. And of course, Jim Cramer today specifically was absolutely coked up. Take a look.
Let the bad times roll. What can I say? When Salesforce lays off 8,000 people or 10% of its staff and the stock rockets higher, you have the blueprint for a tech turnaround. Given the tech's been an ongoing disaster, a millstone around the neck of the market. More than 3% gain in Salesforce in the wake of that news today confirms that even software as a service stocks can rally. A charge of approximately $1.4 billion to $2.1 billion led to a nearly $5 billion gain in market capitalization for the Cloud King. Yes, and I think that the Cloud King's move is just beginning.
House of pleasure.
But at the end of the day, this market has become unforgiving to the fat, happy tech companies that hired too many people during the pandemic and are now seeing that they're not taking the tough actions needed to protect you, protect you, the shareholder.
Okay, how much you want to bet that this is going to be in late night comedy? The guy is having the time of his life gloating over people losing their jobs. And of course, the CEO of Salesforce, Mark Benioff, he has this fake act of the Ohana bullshit. He pretends to be, the all hippie love CEO. Well, he's getting rid of thousands of employees. How about an apology letter? How about tickets to Hawaii? Something. No, they're getting out of the door with nothing. And by the way, Mark Benioff is a notorious stock dumper. He has been dumping thousands of shares worth billions of dollars from Salesforce for years, every single day. Yet he wants you to believe in his company. The company is going to grow. Well, buddy, if you want me to believe in your company, stop dumping stock. Stop cashing out billions and billions of dollars. Do you now realize that this economy is just one Ponzi scheme? They create these entities, they list them in the public market, and they use the retirees' money, the pension funds, to fluff up the valuation of these equities and these entities. And whether the company actually produces anything that justifies the rise in valuation of the stock, that doesn't matter. The insiders, the executives, use the bubbles and the manias and the rise in valuations beyond any justification to dump stock and cash out. And this is why they're filthy rich. Billions and billions of dollars. You see, back in the day when you were naive, you thought, all of these CEOs, Bill Gates, Mark Benioff, they're all rich because they're smart. The answer is they're not really that smart. They're rich because they know how to play the game, the rigged game, the Ponzi scheme that we call the economy, where you lose and they stand to win every single time. Mark Benioff has been dumping billions and billions of dollars worth of Salesforce stock while your retirement fund, your pension fund, your investment fund continue to buy and hold the bag. Lovely night story, isn't it? But hey, we have to move on here before we say goodnight. we have to cover the stock market for you. Let's do that by covering the closing of the indices today. And here we go. Higher we go. Higher for longer. How about that? The Dow Industrial Average in the green by 133.40 points, or a gain of 0.40%. The Nasdaq also in the green by 71.78 points, or a gain of 0.69%. The S&P also in the green by 28.83 points, or a gain of 0.75%. When we look at the sectors, all in the green with exception of energy again. Is it profit taking? Is it the dollar moving higher? Is it a recession theme? For now, my hunch is it is profit taking, at least for now. In any case, at number 1, capturing the gold, metal, consumer, cyclicals. At number 2 for the bronze. Number 2 for the silver, real estate. Number 3 for the bronze, materials. When we look at the advance to decline ratios, the NYSE 76% advancing versus 24% declining. The Nasdaq 68% advancing versus 30% declining. Decent breadth across the board. Is it going to last or not? This is what we're going to explore in looking at the heat map analysis, most importantly, the charts analysis. But before we do that, let's cover the commodities. And what we see here is the dollar flattish for the day. It was down, then it went higher. Of course, the Aussie and the Kiwi were rallying higher in the morning. So did the Canadian dollar, and that kind of poured cold water on the rally for the US dollar. So the action in commodities was all over the place. Energy commodities down big, led by crude, WTI, Brent, all down almost 5% in a single day. Massive loss here for crude. Gasoline RBOB down almost 4% for the day. Heating oil down over 2.5%. On the other hand, the formerly known as the party boy, natural gas with a rebound of about 4% today. And the question that we have right now is money coming out of crude and moving back into natural gas? We know that nat gas has been getting hammered as of late, and the reason is we have a warmer season in Europe. But the season is still young. Anything could happen here. Sooner or later, natural gas prices are going to rebound big time. Is it the time to buy right now? That I don't know. I attempted to buy, and I got a pie in the face. So the timing becomes really, really important. When it comes to softs, down across the board, led by coffee futures down a little over 3.25%. Cotton futures also down almost 3.25%. Lumber, sugar, all down, yet we have some positive activities led by cocoa futures up around 1.5%, OJs up around 1%. When it comes to metals, the mystery continues. Why is gold moving higher while other metals are not doing the same? While the dollar remains sticky, not moving down, actually moving higher as of late, why is gold rallying hand in hand with the dollar? One of these two is lying. And my hunch is the old man gold, at least for once, is the one lying. Today, gold was up a little over 0.75%. On the other hand, silver down by a little over 1.25%. So what's going on here? The action is all over the place. When we have this kind of confusion, we have to look for Dr. Copper, another sensitive commodity to the US dollar. And Dr. Copper has been going down. So my hunch is, once again, gold is catching a fake rally here. When it comes to meats, they've been holding ground while we see energy commodities moving down. Meat commodities are holding ground, and therefore we see food inflation being stickier than any other form of inflation out there. And I talked about the company Tyson. I added Tyson to my portfolio recently, and the reason is I see commodity prices for meats moving higher, and Tyson still has the pricing power to continue to raise prices without denting demand dramatically. In any case, the leader for meat commodities today, feeder cattle with gains of a little over 1.75%. The loser, lean hogs, down by a little over 1.75%. When we look at grains, down across the board, led by wheat down by a little over 3.5%. The bet was that the deep freeze that we got will damage wheat crops. This will reduce supply, and therefore prices of wheat will move higher. On the other hand, when we look at the headwinds, you have the US dollar moving higher and the conflicting information that we continue to get out of China. Are they going to reopen, and are they not going to reopen? And this is causing commodities to be really, really volatile. On to the options market, the big casino. What do we see here? The hottest table by far, and has been the hottest table, Tesla, with around 3.3 million contracts traded today. Of course, the name moved higher today, but here comes the bearish bets right away, and we see that puts outweighing calls 60 to 40%. At number 2, Apple, with around 1.7 million contracts traded today. About 66% of those were puts, not calls. Amazon, at number 3, with around 1.5 million contracts traded today. About 72% of those were puts, not calls. Now, mind you, we've been talking about Salesforce course, with the mass layoffs, I just got the news that Amazon, breaking news by the way, that Amazon is about to lay off 18,000 employees. So here we go. That tsunami of layoffs. Anyhow, we have to move on to the unusual activities that took place in the options market today, and we begin with the ticker FXI. This is the Chinese technology ETF. It has been on fire as of late, moving higher and higher and higher. A lot of you say, hey Maverick, still bearish, still neutral on China, not hopping in, not buying? My answer is no, I'm not chasing anything here. What's going on with Chinese equities right now, specifically those traded here in this country, the FXI, MCHI, BABA, JD, etc., is nothing mere than buying the losers, short covering, a combination of both. But is there a fundamental case that China will be the exception in a global recession? The answer is absolutely not. So what I'm doing right now is wait for it, let all of the stampede happen, let all of these Chinese names and equities, ETFs, become really, really overbought, and then hop on the other side and short them all the way down. But in this case, somebody sees more gains to come before that happens for the FXI, and they bought the 36 calls for the expiration date March 17th, with expectations that the FXI could move higher and gain more than 15.5% by then. They paid around 60 cents a piece to enter this trade, all in all spending around $2.8 million. And then what about the trade for the XLI, or trades, I should say, for the XLI? This is the industrial ETF. Now, somebody sees a major move coming one way or the other, up or down by about 8 to 10%. They're not sure. So they're buying calls and puts in what is known as a strangle trade. So they bought the 91 puts and they bought the 109 puts, all for the expiration date of February 3rd. The spread is really wide here, so be careful. We're not going to follow this trade at all. We're just covering for illustration purposes only that there is a major move coming in industrials. That includes Boeing, that includes the defense contractors, that includes names such as 3M, trucking names, housing names, manufacturing names, etc., etc. But in this case, they paid about $2.40 a piece for both contracts, and that brings the total all in all to about $10 million. And then we have an interesting one here for the SPY, the S&P 500. Somebody sees more gains to come. Somebody sees the SPY going higher for longer, perhaps beginning of the year rally, and they're riding this wave by buying the 408 calls for the expiration date March 31st. And the expectations are that the SPY will move higher and gain more than 6% by then. They paid around $6.50 a piece to enter this trade, all in all spending around $5 million. And lastly, at the bottom of the table, what about the ticker RBLX for Roblox? Somebody sees the name rebounding and moving higher, and they bought the 31 calls for the expiration date January 20, with expectations that the name could move higher and gain more than 7% by then. They paid around $1.30 a piece to enter this trade, all in all spending around $1.3 million. On to the heat map analysis. What do we see here? Once again, a lot of weakness happening in the health insurance names led by United Health, the ticker UNH. So we're seeing a lot of profit taking here. We're also seeing weakness in oil and gas. Not as bad as yesterday, but perhaps the drain is over now. Folks booked some profits, and now we have other folks waiting on the sidelines about to hop in. We'll see if that happens or not. But we also see the industrials down big, some names at least. Some of the winners of last year, such as NOC, Northrop, that was down today. Honeywell, HON, was down. And then here it shows that GE was down big. In reality, it was not down. I think it was a reverse split, and the name was up by about 5% for the day. But notable in the action today, yesterday we saw Apple and Tesla down. Today, both Apple and Tesla moving higher. And we're seeing Amazon, Google, and Microsoft down instead. And of course, they attribute the move down by Microsoft to a downgrade by UBS. In reality, I think the down move in Microsoft today is due to the weakness that we got from Salesforce, an indicator that software, the growth, the momentum, all of this is slowing down. And while Salesforce moved higher based on layoffs optimism, that spells problems for Microsoft because we're going to see Azure slowing down, and soon enough Microsoft will have to lay off thousands of employees too. Another notable weak name today is Pfizer, and it was weak yesterday. It is weak again today, and the question becomes, is it profit taking? Since the name is a winner last year, perhaps we're seeing some profit taking here. I disagree, because if that is the case, then why is Merck moving higher? Merck was one of the major winners of last year. Why is Merck moving higher, Pfizer moving down? Or is it in relation to this story? I'm pretty sure that pretty much all of you heard about the Buffalo Bills game and Damar Hamlin collapsing on field. A lot of folks are saying this is due to the jabs, due to the Pfizer jab, etc., etc. I don't know if that's real or not, but maybe this is the real reason behind the collapse in Pfizer shares, at least as of late. And then we have news for Tesla. Not the news I was hoping for of a new CEO, but the news this time around of Tesla witch Cathie Wood buying the dip over and over and over again. And she has been catching a falling knife over and over and over again. But today was a good day, a rebound day, and now I'm questioning my position in Tesla. I'm playing the oversold rebound, but when I'm in company with Mama Cathie, it's not good company. So I have to think about it now. And since we're talking about autos, we got news. Good news for GM. GM is now reclaiming the U.S. auto sales title #1 from Toyota. So do you buy GM shares right now? The answer is not really. Because while GM came out at top, all in all, sales are down. Last year's sales total would rank as the lowest since 2011, another recession indicator. The consumer is now spending more on food, groceries, the gas store, utility bills, rents, etc. They no longer have the liquidity to go out and buy new cars, even used cars. And therefore sales are down, prices are down, and the morons of course say, hey, look at this. Inflation is going down, buy. But inflation is going down for the wrong reasons. You geniuses. And then we have another crappy car manufacturer, Stellantis. They're now looking to manufacture electric flying vehicles. And I say, how about you produce regular vehicles that last for at least a little over 6 months? You buy a vehicle from Stellantis, Chrysler, Jeep, whatever. You slam the door a little too hard, the whole car falls apart. And this company wants to manufacture electric flying vehicles? What a disaster in the making. And then we have another name, moving higher. So Pfizer goes down, a lot of the winners are moving down, the tech cohort moving down, but Verizon is moving higher. And guess what? Verizon is one of my top picks this year. I talked about the recession theme coming in 2023. You want to be in boring names such as Verizon. Verizon went down big last year. It pays a decent dividend. It is the kind of stock you want to be in. The theme in 2023 is going to be boring, cash flow kind of stocks. And to sweeten the deal, now Verizon is expecting to cut capital spending by 23% in 2024. So the margins are expected to improve. Good news for Verizon. And then we have bad news for Meta. When it rains, it pours. Meta is being hit by $410 million fine over ad targeting. Now, this would never happen in this country, of course. And the reason is the regulators are bought by Meta and other tech companies. They work on behalf of these companies not to regulate them, but to manipulate the economy in their favor. And lastly, in corporate news, we have BlackRock, and I made a mistake on Twitter. I said Blackstone, it's BlackRock. But it doesn't matter. Let's hope both of them burn down because both of them are suspending withdrawals from the property funds. In the case of BlackRock, the $3.5 billion UK property fund. What's going on here? Something big is brewing. Smelling a crash in the housing market coming. What happened last year? That's nothing. That's just the warm-up. This year and beyond, we're getting the crash in the housing market. And of course, the majority of Americans are cheering for a housing crash. And the reason is, who can afford a home these days? Nobody. On to the heat map for the ETFs. Green across the board with very few exceptions. But notice the action here that we've been getting so far this year. US ETFs, US markets down to flattish. Overseas markets, be it European, developed, emerging, Chinese, all moving higher. So is the opportunity overseas not here? I say don't be duped, don't be deceived. We see this kind of action in the beginning of the year, buying the losers from last year, and that is always proven to be a trap in every bear market. So watch out here. If you see the losers popping higher, be careful of being sucked in without having a fundamental catalyst to support your entry position. Let's move on to charts and then wrap it up. And we begin with the SPY, the S&P 500 30 minutes chart. What do we see here? The answer is nothing happened. Still within range, the support 379.5, the resistance 385, nothing happened today at all. But are we seeing an improvement in the momentum for the SPY? The answer is perhaps. We're seeing higher lows. But the ultimate confirmation would be closing the day above 385. And that has yet to happen. But I would say comfortably, the path of least resistance right now is higher, absent of a fundamental piece of news that ruins the party. Because when we look at the daily chart for the continuous contract for the S&P 500, again, It is a bear flag consolidation pattern. But the question is it going to play or not? Because for now, the chart is asking, do we have any buyers here? Legitimate buyers, not the traders who get in the morning and dump in the afternoon. Any legitimate buyers before we go down? And the momentum indicators, the RSI and the MACD, they're saying yes, the buyers are coming. And when they come, the bear flag doesn't play out, and we see a pop higher, perhaps all the way to 3,960, if not beyond. And then the flush down comes. But what if the buyers don't show up? What if this Salesforce news and the Amazon news that we're getting right now will panic buyers, make them have second thoughts about buying the market right now? If that is the case, then the bear flag plays out. But from a technical perspective, ladies and gentlemen, we have to use what we have. And what we have right now is a consolidation pattern that could play to the downside, or the buyers could step in and move it higher. The only other piece of evidence that we have from a technical standpoint, once again, is the momentum indicators, the RSI and the MACD. Both of them are saying the momentum is improving and moving higher. So we have to play with what we have here and assume that the path of least resistance is higher, that the bear flag is not going to play out, and we're going to move higher for a little while here. What about the Qs? The Nasdaq, again, within range, no update at all. The support remains 261.69 and the resistance at around 269.29. But again, if the Qs wanted to dump big time, it had the aftermath of Christmas, it had yesterday, today, and the dump never happened. Even though we got bad news from the Fed, the FOMC minutes, and the hawkish rhetoric by the demon from Minneapolis, Neil Kashkari, yet the market, the Qs in this case, continues to hold ground. And in a consolidation pattern, just like we're seeing here, with defined support and defined resistance, you don't want to make major trades unless we have a breakout one way or the other. Above 269.29, we're buying calls. Below 261.69, we're buying puts. But in the meantime, in a consolidation pattern just like this, how do you trade it? The answer is you do day trades. With shorter expiration date, by the end of the week, you get in, you get out in the same day. In, out, hello, goodbye. Always be closing. And your boy today was not really sitting at the office and watching the stock market or trading, but I was at Lowe's because I have a home project that I'm working on. Yet I'm looking at the phone, I'm looking at the charts, and I'm seeing an opportunity here. Why am I seeing an opportunity? The Qs moving slightly higher. Of course, the news by Microsoft down, that is impacting the Qs down. But I see Tesla up, I see Apple up, I see the VIX moving down. You put two and two together, the momentum today is to the upside. In other words, the opportunity becomes in buying the dips, buying calls right away, and dump them immediately, within an hour or two. If the move happens, if the move doesn't happen, you get out with minimal losses. And this is exactly what I did today. And I'm quite ashamed to say it because I used Robinhood to trade, even though I'm shorting Robinhood because I'm betting it's going to go bankrupt, but I was not on the desk. So I had to use Robinhood while shopping at Lowe's. And I did buy Microsoft calls. I bought those at around 7:35 a.m. and I dumped them about an hour later at around 8:44 a.m. and I walked out with a decent profit. In, out, hello, goodbye, always be closing. And it was a steak and lobster kind of day. Another one I did today is Apple. Apple moved higher in the morning initially, then it went down. But again, I'm looking at the indicators. I'm looking at the dollar, I'm looking at the 10-year, I'm looking at the VIX, I'm looking at other names beside Apple. I'm looking at chips, for example, moving higher. And my hunch is the dips will be bought. Apple is going to move higher again. So what do? At around 7 a.m., I buy some 130 contracts for Apple, 50 cents a piece. And about 2 hours later, I flip them for profits, almost double my initial trade. Once again, in, out, hello, goodbye, always be closing. Steak and lobster, baby. Again, in a market in consolidation, you're forced to conduct day trades, short-term expiration. I'm usually not a day trader, but when I see an opportunity, I'm going to pounce. And the question becomes, where is the momentum for the day? And clearly, from the get-go, the momentum was higher. So the dips are used as an opportunity to buy some calls, a little bit out of the money. You get in and you get out within the same day. You don't get too greedy. You make a decent profit. You thank the Lord and you get out. Until we see a breakout out of the consolidation pattern, and then we buy serious call and put options with longer expiration dates. But here's the daily chart for the continuous contract for the Nasdaq, and again, it is still below the June bottom, so the Nasdaq is not out of the woods yet. When we look at the momentum, the RSI and the MACD, they're firming up, indicating that we're now waiting for the buyers to pop the chart higher. above the June bottom. And absent of a surprising fundamental piece of news, the path of least resistance right now is higher. But we have plenty of resistance after the Nasdaq recaptures the June bottom as support. So we have no other choice but to play the game right now. If the Nasdaq cracks above the June bottom 11,058.5 and closes the day above this number, and we see a crossing in the MACD indicator producing green impressions in the histogram, all of these are indicators that we have a beginning of the year rally coming. And you gotta play it until it fades away, and down we go again. What about the IWM, the Russell 2000, small caps, 30 minutes chart? What's going on here? It popped above the important number of 174.22 and it closed the day above this number. All of this is positive, and again, absent of a surprising fundamental piece of news that comes out negative, the assumption for now is the IWM, the Dow Jones, the SPY, the Qs will all start to move higher. In the case of the IWM, it managed to close above the important number of 174.22. You can't look at the action today and say this is bearish, folks. It has to lose the important number, close below it for the day, and close below the gap, and then it becomes bearish. But for now, assuming that the IWM moves higher, what is the next resistance? Because we have 183 that is far away. I doubt that the chart's going to make it right there, but we have an immediate resistance at around 177.31, which also happens to be the top of the rejection candle that we got yesterday. What about the Dixie, the dollar index? What's going on here? The momentum is firming up, both in the RSI and the MACD. Today was a down day, but again, relatively speaking, when we have the Aussie and the Kiwi moving higher, along with the Canadian dollar, all with gains above 1%, and the dollar closes kind of flattish, that is a win for the dollar. But here's the confusing part. While the dollar did not break an important support, in this case 103, gold managed to crack above an important resistance of 1842. So does that mean that we should buy gold here? The guy you're listening to right now is not going to do that. My hunch says we're going to have a flush down in gold coming soon. And the dollar has one more pop to go before it goes down again. What about Brent oil, the weekly chart? What's going on here? Look at the MACD indicator. It is not crossing and producing green impressions in the histogram. It is actually moving down, losing a lot of momentum. And the RSI is also losing a lot of momentum back in negative divergence. Most importantly, the chart lost an important number, 85 as support. Not looking good for now. The week is still young, but if this continues, this could be A, B, C pattern to the downside, and if the support of 77 is gone, we will see UK oil, Brent oil down at around 62.5. That is the next support. And that's not going to be good for oil stocks, folks. That doesn't mean I'm going to short Chevron or Exxon, the big ones, because they will continue to make profits and improve their margins at these levels of 60 plus. But I might go short on the high beta ones, the smaller producers. Those are the ones that are going to go down the most. But the week is still young. And here's the daily chart for the 10-year yield. What do we see here? Lost an important support, but watch out, this could be a reverse head and shoulder formation in the making. And if that is the case, the 10-year moves higher. With all of this hawkish talk by Kashkari and the rest of them, we cannot say for sure that the reverse head and shoulder is not going to play out. Matter of fact, the odds at least become more favorable toward the reverse head and shoulder playing out, which means the TLT, and we talked about this yesterday, it went all the way to the gap support / resistance at around 103.5, and it pulled back. Yes, the RSI is improving from a daily perspective. Yes, the MACD is improving, but can we say for sure that we should go along the TLT right now? Not until we know for sure that the reverse head and shoulder is not going to happen in the 10-year yield. Because you can look at this, the TLT right now, as an actual head and shoulder formation. And down it goes from this point on. We're not out of the woods yet. Be careful of buying the TLT right now. You need to see a little more. What about the VIX 4 hours chart? What do we see here? We have a gap and crap. The gap started yesterday. Today we have the crap. Not quite all the way to closing the gap at 21.83, but that could happen as soon as tomorrow. Now here's the thing. If we clean up the chart and we use a line chart instead, what do we see here? Is this the beginning of a reverse head and shoulder formation and higher it goes in the VIX? Too early to say, but you got to keep an eye on that. So the assumption of the SPY moving higher, we're not out of the woods yet. And therefore I say if you want to make major trades one way or the other, you got to wait for these breakouts to happen. You got to wait for the SPY to crack above or below the range it has been trading on for few weeks now? You got to make sure that the VIX is not making a reverse head and shoulder formation before you buy any contracts from this SPY. For now, it is a day trading kind of market, at least for now. And of course, we talk about why isn't the VIX popping higher big time? Because when we look at the put to call ratio, it is the highest on record, meaning the VIX should have blown up to 100, 150 even. Why didn't the VIX explode higher? Perhaps this explains it because we have a lot of theories. I don't like to say conspiracy theories. I like to say theories that the VIX is being manipulated to the downside. But this could be an explanation. We will look at the equity put to call ratio, the mid price, and then the intraday equity put volume, most importantly. We see that traders are getting in and out within the same day. So they might be buying puts, but they get out right away within the same day, the very next day, and this is making it hard for the VIX to sustain a rally. So maybe this is the reason behind the VIX being subdued while we see extreme volatility taking place in the market. Apple 30 minutes chart, what do we see here? Yesterday I talked about how last week they gave the bulls a trap, and now they're going to serve the bears a trap. And indeed, this is what happened today. The bear flag pattern did not play out. We have a gap higher instead. And the question becomes, is that all there is for Apple? This little pop that it got today, and then down we go? The answer is not quite. I mean, you can look at it one way as a cup and handle formation. This is the obvious. But if we zoom into a 5 minutes chart, what do we see here? We have a gap support. And every time the chart today moved down to this gap support, it bounced higher. Not once, not twice, but 4 times. Now, a lot of folks would read this as, oh, the chart is knocking down at the gap support. Sooner or later, it cracks below it. I look at it the other way. I look at it as the chart is going back over and over and over again in a retest to that support. And it continues to catch support over and over and over again. At some point, the chart becomes confident that this is a decent support and it starts to move higher. If that is the case, obviously, we have the top of the breakdown candle. Let's call it at around 130 as a profit-taking target. Next, we have Tesla 30 minutes chart. What do we see here? Again, I talked about how they're going to serve the bears a trap since they served the bulls a trap by the reverse head and shoulder pattern. And indeed, this is what happened today. We see Tesla moving higher. And the question becomes, how high can it go if this continues? We can look at this as a bull flag pattern, and if it does move higher, we have target number 1, the top of the breakdown candle at around 118.5, and then we have the gap at around 122.37. For now, the assumption is Tesla should move higher because the daily chart is really oversold. And last but not least, Bitcoin, a daily chart. Any update here? Nothing at all. Bitcoin remains flattish, no action at all. The asset popped higher today, but is it enough to reverse the bear flag pattern? The answer is not really. Is it enough to say that Bitcoin is out of the consolidation pattern? Not really. We need to see it closing above 18,000, and then we're talking. Otherwise, the consensus is it goes down to 15,000. And here's a bonus chart for you. JP Morgan Chase, the Landromat. Here's a weekly chart, and tomorrow, I believe, JPM pays dividend, so we might see the stock down. Now, remember in the day trades that I just talked about, if the momentum all in all is higher, if we see a rally across the board, and JPM opens down, that would be an opportunity to buy some calls here and score some quick profits. JPM is now in a critical range. It has been support and it has been resistance in the past. The question becomes, a break above this zone that you see right now will be a signal to buy. A failure to break above this zone and a break below it will be a signal to short. So keep an eye on JPM. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the ADP employment report. We have the continuous jobless claims. We also have the U.S. Services PMI, and most importantly, the bull slayer, St. Louis Fed President James Bullard speaking. So you might want to buy some calls, playing upside until Bullard speaks, and then take your profit and wait till we hear what he has to say. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.
Well, I'll tell you what, Ivan, you're fired, is what it is.